guys ever wanted to read financial statements like a balance sheet, an income statement, a statement of cash flows? Well, good thing my name is Freddie Finance, because in today's video, we're going to go over how to read a balance sheet so that you can make the best investment decisions. You guys are probably wondering, why would you listen to me about how to read a balance sheet? Let's go to some financial analyst. Well, you can, but you also have to listen to their financial lingo talk while I can break it down for a fifth grader. Because I'm a licensed financial advisor, I hold a Series 7, Series 66, Securities Industries Essentials, and my life and health insurance license. Let's dive in. But before we go into reading an actual company's balance sheet, let's understand what it is. The balance sheet is one of the three most important pieces of information that a company can have and use to make better business decisions. And a company's balance sheet displays how the assets are financed and how much assets they have. A company's balance sheet is pretty much equivalent to an individual's net worth. It displays, how much assets they have versus how much liabilities. So the most important equation I want you guys to understand in the balance sheet is that assets equal liability plus equity. Now let's pick a company's balance sheet, look through it, and then see how we can understand it. We're going to use Tesla. So we're going to pick this up on Yahoo Finance, and we are taking a look here at Tesla's balance sheet. Whenever you're looking at a company's balance sheet, it's going to be telling us what the company owns and how much value of whatever they own is. The balance sheet truthfully shows what the company owns versus what it owes. And it's so important to understand that in business, each asset is almost always tied to a liability, which is why the balance sheet is so important. It needs to balance out. So tying this back to Tesla and reading their balance sheet, we can see that this is a fantastic company. First thing I'd love to look at is obviously total assets. And since we can look at the past 4 years, their assets have increased substantially, almost pretty much doubled since 2018. That's incredible. After I see a company is rising in total assets, I get more intrigued. And then I like to look at the total capitalization, which by definition is the total long-term debt and all types of equity of a company that constitutes its capital structure. So seeing that the total capitalization is increasing, that means Tesla is taking on more debt. But that's not necessarily a bad thing, because their total assets are increasing very well along with it. A good sign. And since Tesla is a car company, I'm going to look at the net tangible assets next and how those compare over the years. Tesla's a car company. Cars are tangible things. This is an important balance sheet item for Tesla. And since 2018, their tangible assets have increased more than 6 times, or around 6 times. I mean, that means that they are making much more cars. That's a good sign for a company, a car company. Now let's check out working capital. And if you see how Tesla's working capital has flowed through these 4 years, it kind of tells the story based on the chart. And this year's working capital has substantially gone down, while their assets have gone up relatively the same amount. And it shows that the company's kind of correcting here in the stock. Since the beginning of the year, it's been fluttering around all-time highs, and stocks are quite cyclical, and the economy is hurting every stock. So as you can see, Tesla's taking a hit, but it's stabilizing as support here in this zone, which is a good sign. But so the working capital has gone down. That means that that tells me that Tesla as a company is starting to stabilize for now, because they know that times are tough. People are not going to be buying as many cars right now. So they know what they're doing while lowering their total debt. So that's a sign of a super strong company if their working capital goes down and they still are rising in book value while lowering their debt. It could sound confusing if you don't understand finance, but trust me, that's a sign of a strong company. Lastly, it's always important to look at the shares issued. That's the amount of stocks that they have available for people to purchase. And it's a good sign when the company is not, creating more shares, because if you create more shares, then the value of the stock is going to have to go down. So it's not too important really to look at, but it's good to keep an eye on, because it helps you plan your next move, whether it's a sell or a buy if they split. So let's try to sum this up. A company's balance sheet is basically a snapshot of their assets and liabilities at whatever point in time you're looking at it at. Most fundamental analysts focus on the balance sheets when considering a new investment opportunity or reevaluating a current investment. And the primary reasons that these balance sheets are so important is that it's great to analyze if a company wants to merge, maybe liquidate some assets, or invest in another company. And honestly, it can be confusing if you don't study finance, know accounting to look at exact like net tangible assets, working capital, invested capital. If you're just like, a regular investor that's looking to build a long-term portfolio but still wants to read balance sheets, you pretty much can just look at the assets minus total liabilities. That's the simplest equation to tell you, if a company has a strong balance sheet, if they have more assets than liabilities. But based off what company you're investing in, certain balance sheet items are more important. Like I mentioned, how Tesla is a car company. Net tangible assets is very important for this particular balance sheet. And I hope that makes sense. And my name is Freddie Finance. So if you learned one thing about balance sheets, I believe I deserve a like, a subscribe, and a share. So if you have any questions, drop them in the comments. I'll catch you guys next time.